Let's talk about a scenario, the inflated expense report. Imagine a business owner, let's call them Bob, who runs a small bakery. Bob decides to inflate his business expenses on his tax return, claiming he spent much more on ingredients and supplies than he actually did. He figures this will reduce his taxable income and therefore his tax bill. This, unfortunately, is a classic example of tax fraud. So, Sam, to kick things off, what constitutes tax fraud and what are the potential repercussions?
Tax fraud essentially boils down to intentionally misleading the IRS about your financial situation to avoid paying your fair share of taxes. In Bob's case, deliberately inflating expenses falls under this umbrella. The repercussions can range from significant financial penalties, often much higher than the initial tax avoided, to criminal charges, including fines and even jail time. The IRS takes this very seriously.
So if I understand correctly, even if Bob thinks he's just being clever by exaggerating his expenses, he could actually be facing serious legal consequences. This isn't just a slap on the wrist, right?
Exactly. The IRS distinguishes between honest mistakes and deliberate attempts to deceive. There's a big difference between accidentally miscalculating a deduction and knowingly fabricating expenses. Intent is key here.
That's a critical point, Sam. The IRS looks at the taxpayer's intent. And Taylor, to your point, the penalties for fraud are much steeper than those for simply filing late or making a calculation error, as we discussed in our previous segments. Our reference article highlights that the penalty for tax fraud can be up to 75% of the underpayment due to the fraud.
Wow, 75%. That's a huge chunk. This reminds me of what we discussed about the penalties for failing to file, which, while serious, are nowhere near as severe.
Precisely. And let's not forget the potential for criminal prosecution in cases of blatant fraud. Sam, could you elaborate on the ethical considerations that should guide business owners like Bob in their tax reporting practices?
Absolutely, Alex. Ethical tax reporting starts with honesty and transparency. Business owners have a responsibility to accurately represent their financial dealings. It's not just about following the rules, it's about upholding integrity and contributing fairly to the system that supports our society. Think of it this way: roads, schools, public services, these are funded by our collective tax contributions. When individuals or businesses cheat the system, it affects everyone.
So it's not just about Bob and his bakery, it's about the bigger picture of contributing to the community.
Exactly. It's about the social contract we all have. Now let's quickly recap what we've covered. Tax fraud is intentionally misleading the IRS, and the consequences can be severe, ranging from hefty fines to criminal charges. Ethical tax reporting hinges on honesty and transparency, representing a broader commitment to the community. Remember, understand the legal and ethical boundaries of tax reporting, and always prioritize honesty and accuracy in your financial dealings. It's not worth the risk. Now, while Bob's situation highlights intentional fraud, there are other ways people run into trouble with the IRS, sometimes through genuinely misguided beliefs about taxation. In our next segment, we'll explore the case of a tax protester who files a return filled with frivolous arguments, leading to further complications.